Fearless investors. I'm super excited about this one. We have a guest on here who is building a company with a debt fund model, and it sounds like they're fully integrated. They buy short-term rentals. Honestly, a ton of parallels to the business that I'm currently buying, or that I'm currently running, right? And so I'm super excited to dive into this one. What are your thoughts, Kyle?
Yeah, I mean, this was pretty new for me. I learned a lot. I've invested into some funds, especially before I really became an active real estate investor. I had a little bit of money set aside. So I said, hey, I'd like to start making some passive income. So I had kind of selfishly asked at one point during this conversation, like, hey, what are some things that are red flags and what are some things that are like questions that you should ask to funds if you're going to invest? Because I personally think that the investment I made in the fund is okay, but I think there was a lot better options out there. And I just didn't really have those questions or have that knowledge before. So I hope everyone who's considering investing in some sort of passive investment, whether it's short-term rentals, multifamily storage, whatever it is, like knowing these questions would have helped me out when I was looking to invest in a fund. So I found the whole thing really interesting though. And Taylor's a killer.
Yeah, absolutely stud. And he dives into a lot of really this part of the short-term rental space that I don't think a lot of us are super informed on, which is kind of the capital market side. But he speaks to a lot of the operations and things of that nature. So I'm super excited. Let's go ahead and just dive right in.
Let's go.
Fearless investors, welcome, welcome. I'm super stoked about today because we got somebody that I'm a huge fan of his work. I followed him on LinkedIn for a while now, and he is a dog in the capital markets, specifically as it pertains to the short-term rental industry. And so we have with us today Taylor Jones. He is a fund manager of TechVestor. They specialize in STRs and acquisitions, and I'm just super excited to have him because he is an absolute stud. Taylor, welcome to the show, my friend.
Thank you, man. Love the kind words there. Thank you.
So Taylor is he's out of Florida. He has been running. He's a fund manager, but I just want to let you kind of do your own introduction because you guys do a lot. You have your hand in a lot of pockets. So tell us a little bit more about what exactly you do as a fund manager, what your business is about, and I'd love for you to introduce yourself, brother.
Yeah, appreciate it. So we wanted to bring the opportunity for people to passively invest. If anybody has bought or operated their own short-term rental, they realize it's an operations business. It is not a real estate business. And I always joke, you're buying an operations business that just so happens to have a piece of real estate attached to it, not the other way around.
Amen.
And, so, there's a lot of busy professionals, high net worth individuals who want exposure to the asset class. There's obviously great yields. And as we've seen, multifamily, self-storage, industrial, and other asset classes kind of compress with yields over the last 24 months in particular. Short-term rentals have kind of been that great opportunity in hospitality as a whole, where you can get, above market yields. And if you don't know what you're doing, you don't know the best markets to invest in, we wanted to kind of bring that opportunity. And in fact, we actually started out as a software product. So we had this big question ourselves, where is the best places to buy short-term rentals? And we built our own software to be able to source, find, underwrite short-term rentals at scale. The problem with that is most people just buy one or two and then they fall off, and that creates churn. And if you've ever run a software business, churn is the worst thing you could ever deal with. And so we quickly realized we had this problem of people using our software, finding a great cash flowing opportunity, and then they would cancel their subscription. And ultimately, we pivoted to a done for you service where it was like, hey, use our software and we'll help you find, renovate, design, and operate your own short-term rental for you. You're just putting up the capital, you own the asset, we'll do it all for you. What we learned after we did those first 6 clients is, they all got together kind of on a Zoom call like this, and everybody started talking about each other's property. Like, man, Kyle, I love your property, and John, I like your property, and Billy, I like yours. They were kind of all describing a syndication. They none of them talked about their own property. And we kind of said, hey, what if you guys were able to kind of roll your assets in and get a piece of each other's and the rest of this portfolio? And that ultimately was the start of our first fund. And we've since gone on and in that first fund bought 81 short-term rentals. And now in our second fund, we've bought over 60, and that one is still up, active, and going. And You know,
Love
it's
it.
been an insane journey, but that was kind of the starting point and where it's grown to today.
Love it. Love it. Love it. You described so well and clearly like the problem that most investors realize when they take a part of this asset class is that it is operations heavy, right? And you guys are solving a super niche problem because there's a lot of people out there that want to divest. They want to diversify what they're doing, but they don't have the time, especially high net worth individuals. And so I think what you guys have done is genius. What I'd like to dive into a little bit more and get some clarity on is what does your team look like? Like, is everything in house? Are you guys doing, you're obviously doing design, the acquisition, all that. Is that everything that's under the same umbrella? Are you utilizing other design local companies, management companies? I'd love to hear more about kind of those layers and how they work.
Yeah, so we actually started out and the whole idea was let's stay lean, let's outsource everything and keep it small, low overhead. First couple properties, first couple vendors, designers, contractors, everything, you get let down and you're like, okay, I can't control the success of our firm. And so we quickly realized we have to bring everything in house. And we've made some critical pivots over the last 2 years of doing this. And I think that's one thing we're really great at is staying flexible and nimble as a team and as an infrastructure. But ultimately, we brought everything in house. So we acquire in house. We renovate in-house, we design in-house, and then ultimately we do operate in-house. So we do manage our own assets. And what we kind of feel is nobody cares for these as much as we do. Nobody else has that same skin in the game. Ultimately, when you do take on other people's money, there's a fiduciary responsibility. And we just feel like those incentives aren't aligned. Ultimately, we're responsible. We're signing on the debt. We're taking in that capital and have to answer to our investor partners. So we brought everything in-house. And ultimately, what that's also given us is strategic advantages from a OpEx perspective, because we're able to see where the gaps are. And because we own those SKUs, we can go in and make adjustments and, lower those costs, which are ultimately going to increase returns to both us and our investors.
Yeah.
That's great. I've got a quick, just clarifying question. So as I'm understanding it, and especially whether it's a host listening right now that might want to do what you're doing, or it's maybe an investor that says, hey, I don't want to be hands-on. What I'm understanding is because it's a fund, they're investing in the entire portfolio. And that's really kind of spreading the risk so that if 123 Main Street doesn't perform this month, but 246 Elm Street kills it, they get the average of that across the entire portfolio. It's just simple. Yes. Is that what it is?
Yeah, absolutely. It's exposure to a diversified portfolio. And, what I tell people is the pro and the con to being a part of a diversified portfolio versus owning your own. On your own, you do get all the upside. So if you nail the buy side, you get all the upside of the return. You also get exposed to all the downside. Or what if you buy an STR in Miami and one hurricane wipes you out for 3 months and now you're offline? Yep. Versus in that portfolio, you get that blended average. So yes, your upside is of course capped in a blended portfolio, but your floor is also significantly higher where your risk is significantly lower in that regard. So it kind of gives you more of that stabilized opportunity. You look at seasonality blend too. We do strategically, we look at asset management very much as a whole, and what markets are high in Q1, which ones are high in Q2, Q3, Q4. And so we're going to strategically balance the portfolio to try to make it as close to long-term rentals as possible from a seasonality perspective, where it's not as feast or famine every month compared to owning your own. You're exposed to all of that. So there is pros and cons to both models. And we just wanted to try to bring that diverse opportunity to, people who want exposure to the asset class.
So perfect. I guess my follow-up question on that is, what are some of the other maybe hidden or not so obvious benefits of investing into your fund or a fund when you look at this asset class?
I think it's taking in the experience and nailing the buy side. If you nail the buy side, you can screw up a lot of things operationally and still be okay. You might not drown, you might not be killing it. If you miss on the buy side, then you need everything to go right operationally. Otherwise, you could risk running in the red. And that's something we've been pretty fortunate. That is that we've learned from our mistakes where we were early on compared to where we are today. There's just huge differences. And we're also growing quicker. Easy stat I always point to is from the day we close to the day we're live on Airbnb, that time period, every day you're not live is opportunity cost loss for cash flow you could be renting. In our first fund, when we first started, we were typically trending around 12 to 14 weeks, for all the renovations, get the furniture delivered, get it staged, photographed, ready to go. Now we're trending closer to 8 to 10 weeks. So
Nice.
we're just more operationally efficient. And those are things with a huge benefit once you have experience. We are forever grateful for everybody who bet on us early when we only had one property, 5 properties. The track record was low. I think the benefit now is we get to look back at 140 plus case studies. And our second fund gets to look back at all those 81 properties from fund one and get better from it. And then ultimately, when we launch our third fund next year, it gets to look back at fund two and fund one and see what worked, what didn't. And so the benefit is every subsequent fund gets to look back at all these case studies. And as we get more firsthand data, we just make better decisions, drive more revenue, and trim our operating costs to get better and better.
Love it. Love it. Love it. This is all super fascinating to me, especially given like you guys there's a lot of like similarities with the company that I own, which is where I kind of want to focus, especially on the buying side. What are you guys buying right now? Like, what are you guys buying in what markets? Are you guys focused on single family? Are you buying some multifamily? Any commercials in there? What are you seeing is working in today's market?
Yeah, I mean, our specialty, we really do a good job about staying in our lane. You can definitely get shiny object syndrome in this asset class. There's great things like, oh, can we go after unique properties, the yurts, the geodomes? Can I go get multifamily? Can I go into luxury? Our bread and butter is single family. We do own anywhere from 1 bed to 6 bed. As of the last 12 months, it's been leaning towards the bigger homes, 4 to 6. Typically, when you're looking at revenues and with the higher cost of debt, you just need to drive outsized yield. And sometimes that gets capped on a smaller 2 or 3 bed. At the end of the day, that small group or one family can only pay so much per night to rent versus the bigger 4s, 5s, and 6s. When you get multiple groups, that cost is spread out more. You're able to increase that average daily rate and squeeze more out of that property. So just naturally, the last 12 months, our buy box has leaned a lot larger with more 4s, 5s, and 6s. If you look at our properties online, it is high amenitized, high design. It's really what we focus on, doing crazy things like pickleball courts in the backyard, miniature golf, playgrounds. We converted a garage into a golf simulator, outdoor bowling, giant chess, movie theaters, game room, arcade, kind of everything in between. We've got some cool stuff in the pipeline too that we're testing out. And I think that's the great opportunity about continuing to buy is there's so many opportunities that we can A/B test things out. And because of our scale, we can see what works and what doesn't and make those adjustments for the next ones.
Yeah, I was just telling Kyle, one of my favorites that I saw you guys had was the sex room or the sex team, right?
No, that wasn't ours, unfortunately. That was a cool one I saw. And
okay.
I would have loved to have done that. We've joked and teased with that. Yeah, there was another host who's getting like 400 or 500 a night with a sex team cabin and
sex sells, baby.
No, I mean it's. I think the point to that though is know your target market, and I mean we've done we have like a pink Barbie style house with the pink kitchen cabinets, pink pool deck, pink wallpaper. And it's specifically designed at bachelorettes, getting 16 groups, groups of 16 women together, and they're paying, $1,500 to $2,500 a night because we nail it. Our family properties, our couples getaway properties, it's a huge mistake we see investors make. They design the property for themselves, not for their ideal booking guest. And that's something we're never going to visit these properties. Like, again, these are all investments. We're not going there. So luckily that emotion is removed. But we focus in on who's our ideal guest for this property and for this market. And we're going to design it specifically for them because those guests will pay a premium to get it exactly right. We have a dude's bachelor getaway house and it's tons of poker tables, four TVs all together in the living room. So you can run 4 different games, basketball, there's, all the different things. And, dudes are getting together and paying a bunch of money per night to do it. And that's, I think, the critical thing we've really learned and just keep doubling down on is design it and add the appropriate amenities for that exact target clientele of that market.
Yeah.
So if I'm listening right now and I'm like, I want to be passive. I own a couple, but I'm tired of operations. What can a potential investor expect for returns with your fund? And what's the buy-in?
Yep. So, what I always tell people, if you own your own assets, to hit that first point, and you want to remove yourself, I've seen people do things as simple as, hey, hire overseas talent to handle 80, 90%. You could obviously
Yeah.
go full property management as well to offset. If you're looking at a passive investment in a fund, with us in particular, it's a 25K minimum. We're only able to accept accredited investor capital based on our structure today. And, ultimately what we strive for on our assets is an annualized 8 to 12% dividend. So once the fund is up and stabilized, ultimately that's what we're, stabilizing at. Our first fund, which is further along, is going to be higher on the metrics versus this current fund, which we're still in process of building. So we need to, again, continue to accumulate those assets. Ultimately, we want to build, stabilize, hold for the next 4 to 6 years, and then there'll be an exit rolling up all these properties together. When we look at the big picture, we've talked to a lot of your favorite color and geometric shape private equity groups that are out there, and the common consensus is a lot of them want to get exposure to this asset class, but there's nowhere for them to go deploy capital at scale. We've heard things such as, hey, we're not going to get involved for under a $300 million check, or hey, we want at least 500 doors. When you look around short-term rentals, where can you write a $300 million check today? Where can you buy 500 doors? And it doesn't exist. Really, you got to go into ground up development. Now you got 18 to 24 month timelines. So what we're trying to build is the void in this asset class that doesn't exist. And it's, hey, how can I get exposure by writing a singular huge 9-figure check, if I am an institution? And that's really what we're solving for. So for us, it's just a brick by brick business. This isn't software. You can't just, scale it quickly. We need to grow profitably. And we're really just putting our head down and growing for the next, 5 to 10 years and building out the portfolio. And then, we'll be sitting on somewhere between 500 and 1,000 short-term rentals here inside the next, 5 to 10 years. And then it's going to be an attractive opportunity to sell. And whether that's selling the entire portfolio to one buyer, breaking it up and selling it to, various family offices or smaller institutions, or if it becomes the most profitable endeavor, we will sell them one at a time as turnkey, stabilized, ready to go STRs to retail buyers. It might be painful, but again, we have a fiduciary responsibility to do the best possible exit. And if that is the best option, we believe it will be selling it all to one buyer, but we're open to exploring all options. And we do have the capability to pursue any of those 3 options that when it does come time to sell.
See, and that's the beauty of this asset class, because what other asset class could you do that, right? Yeah. Like if you're buying a commercial hotel, like your pool of buyers is very limited, right? Short-term rentals allow us to be flexible and fluid, especially in a model like yours. And I do think you guys are really pioneering a trail that hasn't been walked. And so that's where I get excited for you guys, because that's awesome. And you guys are killing us.
I appreciate it. And a huge hack that we've seen is paid off, especially with everything that's going on in a lot of the other commercial assets, is we're securing 10 and 30-year fixed rate debt on these assets. This isn't short-term floating or bridge, albeit we got that debt thrown around and it was cheaper. We could have juiced returns to our investors, but we just didn't feel it was a risk we wanted to take. All of our debt is fixed for either 10 or 30 years. It's a lot of either, 10-1, 10-6 or straight up 30-year fixed. And for us, we wanted to stay conservative. These are great ATM machines spitting off cash every quarter. We didn't ever want to be a forced seller. And, it was very attractive in 2020, 2021 to maybe look at those, floating rate or 3-year fixed rate debt. And we just decided to stay disciplined. It was a little bit more expensive, of course, but as we've seen with a lot of these, maybe multifamily, syndicators and people who did take that floating or bridge debt, that troubles, on the horizon, and people are handing back keys or drowning. And we just never wanted to do that. So for us, we're very fortunate that we're able to kind of operate commercially, but unlock, more conventional debt, which has just been a huge hack that isn't available in any of those other asset classes.
Yeah. So I want to dive into that a little bit then, because, and I don't know if you know much about our business, mine specifically. I am huge on the creative side. And so we've purchased about, 100 doors in the last 2.5 years. Of all 100% seller finance subject to deals, right? Now, granted, these are hard to find. It's a hustle. But the benefit of it, as you know, is we're nailing down interest rates 3-4%, sometimes 2%. How are you guys, like, what debt are you utilizing? You mentioned commercial debt. Like, are you guys buying these in lump sums? Are you, like, that's allowing you to get competitive rates? Or if you talk to me through kind of your debt structure, I'd love to hear that. So.
Yeah, these are all DSCR loans. They're going to leverage. They're going to leverage, short-term rental market rate rents. A lot of them might look at models or data points like AirDNA, to point to the market rents. We've seen debt been all over the place. We've secured, when we first started the first fund, as low as 4.0 and as high as 8.5 at the peak, and everything in between. So obviously it's come down, as at the recording today, we're kind of sitting between the low and mid sevens is kind of where it is, depending on leverage and the state and, a couple of those other little factors. So what we say is, we can't control where the debt is. If we could predict where interest rates were going, we'd be trading futures or options, not building a short-term rental portfolio. So we never try to look at those things. We just control what we can control, and that's buying the best available cash flowing asset at the time of purchase. So when we're pooling investor capital at that given moment, we're looking across the US for where's the best opportunity to deploy this capital. We're going to make the best financial decision to buy the best cash flowing short-term rental. Because if debt, at that peak was 8.5 and it was hurting us, well, guess what? It was hurting all the multifamily syndicators, self-storage, industrial, office, et cetera. It's not like we're independently hurt and everybody else had 4% debt and we had 8.5. So as things come down and get better, I also think there's great, refinance opportunities. We probably have a blended average in the, with a 6 handle in the front for the whole portfolio. If we do ever go back to those 4s and 5s, we do have a great opportunity to refinance our debt into long-term, lower cash out refis, and great events for our investors will open up. We don't underwrite for it. We don't predict it because, again, interest rates could stay where they're at today for the next 5 years. And that is what it is. And it will look great. But I do think if it does go down over the next 12 to 24 months, we're going to be sitting in a great position. We'll have some principal pay down that's going to go along the way. We do a ton of value add anyway, which is kind of trapped in the property, unfortunately, because you can't really refinance some of that right away with prepaid penalties on the DSCR loans. So there's just tons of really good opportunities if rates do go down again. So we're patiently waiting and excited if it does.
So Taylor, you talked about the type of property that you're looking at. What about the type of market? What comes down to your decisions on markets? And we'd love to know some of the markets that you're in as well.
Yeah, well, we start with regulation. It's got to be legal. So if it ain't legal, it doesn't matter how good the underwriting might look or what you think. For us, legal also means there's set regulation. Regulation's not bad. Regulation, I always say, is the city, the state, the municipality. They've just set the sandbox. They've kind of built the sandbox for you, and you just have to stay in that box.
Yeah.
What's scary and what we stay away from is places that don't have regulation. Yeah. It could be legal today, but tomorrow the mayor, the council, the whatever could change and set rules of the sandbox, and I could be left out of that sandbox. So we start there. Is it legal? Then we want to look at where's opportunities that people are traveling to. We do love drivable destinations from huge metropolitans. That's obviously a huge hedge. We also look at where people going and spending money. There's a lot of these like emerging markets and places people talk about, and we've underwritten and looked at them. But the problem you run into is there really that demand? Like, can I suck out a huge average daily rate? Or ultimately, if this is some small up and coming market, people just aren't willing to pay that much. And so ultimately, if we want to achieve a high average daily rate and drive good revenue, we need to do that. So, where our exposure is today, we're in Arizona, Florida, Georgia, North Carolina, Tennessee, Virginia, Pennsylvania, upstate New York, Illinois, and Missouri. So, kind of a lot of East Coast markets. The West Coast as a whole is just brutal when you look at regulations. We look at ROH, return on headache, albeit
that's good.
I'm going to operate in some of those West Coast markets without getting too political. The returns better be 2 or 3x to deal with the return on headache that's going to ensue. And if I have to fight the government every step of the way just to operate my business, it's just not that much fun when you can go get all these great returns, which just tend to end up being East Coast when you look at where we're at, with a little bit of those Midwestern feels mixed in. That's just typically where we see. We're tracking 281 markets in our software. So we're constantly evaluating where's the data looking good, where's revenue trending up. Obviously, it's great if asset prices are trending down at the same time. So potentially over the next 6 to 12 months, we look at our growth pattern. We see some opportunities emerging in parts of Texas, South Carolina, North Carolina, as well as potentially dabbling in Michigan. So that's kind of our like looking ahead roadmap of some of those markets. Obviously, we really study the data. We need at least 60 to 90 days of good trending performance, things moving in the right direction. You know, we don't just jump at a market right away. It really, you know, our team does a good job analyzing and studying so we can make sure, hey, can we go here? Can we stay here? It's just not fun to operate 2 in a given market. We want to operate 20 or 200 eventually. So yeah, we do pass on a lot of markets because of inventory, and you know, density matters at our scale. And if we can't go buy 5 to 10 a year in that market, we're probably going to pass on it, you know, transparently. So we don't just buy everywhere. Everybody just assumes that. We pass on a lot of good cash flowing opportunities just where inventory's choked, and we might only be able to buy 1 or 2 a year. With our operational infrastructure, just doesn't make sense. But if I'm a singular one-off investor, it could be a great opportunity to go get a nice, you know, double-digit return and have a really good asset. It's just not for us in our structure, and that's okay.
Yeah,
that's good. I'm gathering just through what you're saying, there's a lot of team stuff right now. You're probably surrounding yourself with a lot of really smart and good people. What is your role though? What are you doing on a daily basis in this business? And are you eventually as well going to be passive in it?
Yeah, no, I'm leading the acquisition side, and then obviously helping with capital, you know, here and there. But yeah, primarily I'm underwriting all the deals, writing all the offers, talking to different agents, brokers in the markets, you know, getting video walkthroughs, you know, because these are all over the country. We're not flying there and, you know, walking it ourselves. So we have great trusted, you know, realtor partners. We're looking at the photos online, verifying with our boots on the ground partner, as well as, you know, video walkthroughs, analyzing. Ultimately, we're leveraging great tools such as Matterport. Absolutely incredible that you can go in, take measurements of different rooms. We know exactly, oh, that living room wall, it's 112 inches. So the sectional can only be 110. And then that way it'll perfectly fit right there. So it's pretty crazy how we can go in and order everything without actually having somebody there, you know, locally. And it's been a lot of, you know, building out those SOPs and refinement. It wasn't as clean or easy. We did used to send 2 team members to every property early on, those first like 25 or 30. But at scale and what's sustainable, we had to build systems, and we have so much tech, so much, you know, SOP refinement. That's just, you know, we're getting better. We're not perfect, but it's always how can we get more efficient? How can we leverage this? But ultimately, yeah, we're running a portfolio across 9 different states, and you know, it's pretty wild.
It's impressive.
Yeah. That is impressive, especially knowing how in-depth this operations is. And to be in 9 different states. My portfolio is in 1, and it's like, and that's hard enough, let alone 9. And so hats off to you guys. A question I had for you guys, and this is kind of more on the big picture, right? You guys obviously have a goal of disposition, goal of selling it off. I think you're genius by doing it in this asset class because of how flexible you can be. A few years ago, Sunder, I don't know if you know Sunder, if you're aware of them, but they were an arbitrage business that ended up selling. I think it was in the 10 figures. It was for $1 billion or so. Is that kind of the goal for you guys? Like, did that acquisition, and you may or may not be aware of that one, but did that set the precedence for you guys of like what this could become and what you plan on exiting? Or was this something that you kind of just stumbled on and, you know, it was an opportunity that just like was like natural?
Yeah, no, it definitely was kind of stumbled upon. Where we're at today versus what we were predicting, we've wildly exceeded expectations. I think the good news is we bootstrapped the whole thing. We look at what's happened the last 24 months with a lot of the players in this asset class who have either closed doors, have bellied up, or you know, drowned transparently. The common theme we've noticed with a lot of them is they've taken VC capital, and we have had VC capital thrown our way. We have flirted very hard with it, especially when we were running in the red and still bootstrapping early in Fund 1. It was attractive. And we were very close to taking some, you know, huge offer sheets, but ultimately we wouldn't be able to control our own destiny. And so like where we're at today, we're going to scale at our own pace. We're going to scale profitably. We don't have to take on certain risks. And I think ultimately that gives us optionality. We really do enjoy having that optionality and growing at whatever pace us and our investors want, and being able to really control these properties. And, whether it is a cash out sale, or, like I said, a realistic scenario is if debt drops down into, let's just say, a sub, 599 type of scenario, a refinance of the entire portfolio 4 to 5 years from now. Because if we go cash out and all the investors get their return, they 2x, whatever great multiple it is, the first question is, well, where are you going to go place that capital, guys?
Yeah.
And, what are you going to do? Rather than, hey, if we can keep spitting out, double-digit annual dividends, why would we not just refi into more 30-year permanent debt and just keep holding these great assets? And it's not something we underwrite for, but that would be a very real scenario if 4 to 6 years from now, rates are back in the 4s or 5s, is to just turn around and do a massive refinance. Obviously, little bit of, hey, here's some return of capital back, but not a complete exit. We're not opposed to that model. And I think that keeps an option open if the world goes to that, because again, we have these great properties. We know they work. And we're also of the opinion there is a limited number of A-level short-term rentals in this country. And the reason being is there's only so many markets where revenues are high and asset values where you can purchase are low. So you need that spread. Secondarily, if things like regulation are naturally going to shrink supply. So, we believe there's a finite number in this country of A-level properties to own. So for us, we're kind of in a race to get as many of those as we can. And that's where, like, if we do go build this out to 500 units and sell, people are like, oh, you're just going to run it back? And I'm like, it's going to be really freaking hard. Yeah, we have all the advantages, everything, but there is, again, a limited number. I'm not saying it's only 500, but you'd almost prefer if there was a chance to run it back just to refinance and keep going and hold on to all these great ones, because it's only going to get more difficult as time goes on. When people discover a given market, the Smokies was probably, or Joshua Tree got red hot for everybody in COVID. Yields just got compressed in both of those markets, overnight as word got out. And so, yeah, people are going to start hearing, oh, did you hear about this? Did you hear about this? Investors flood in. And if inventory outpaces revenue too quickly, there's no yield. You need revenue to catch up and accelerate with the, increase. So it's 100%. Something we very much monitor and consider as we keep building.
That's good. I've got one last question, but before I do, I want to make sure we give people the chance to join your fund or check out how they can. Where can they go to do that?
Yeah, simple. Head over to techvestor.com. You can book a call with one of our investor relations team members. They'll go through and help with any of the questions. We try to be super transparent. We show historical performance, returns, live data, every performance metric you would want, ADR, occupancy, revenue. I know you said you've seen a lot of my stuff on LinkedIn. People are like, man, you're pretty transparent. You share everything. And, good, bad, or indifferent, I commit to posting on a daily and weekly basis and in all of our performance metrics. And somebody commented one time and they're like, are you ever going to post if you guys have a bad week or a bad month? And I was like, well, I'd be be disingenuous, because if I'm posting when times are good and then I stop, people might learn, oh man, he's just one of those guys. And so I think it kind of puts that pressure on us too to perform well, because good, bad, or indifferent, I have to stay disciplined and continue to post. So it's something we are super passionate about is, hey, here's everything, here's what we're doing, here's our thesis. But yeah, people can go to techvestor.com, book a call with one of our investor relations team members, and they'll be happy to walk everybody through how the portfolio looks, the construction, all the metrics, and what an investment looks like from their standpoint.
Transparency is key. I love that. So my question to you, Taylor, is if anyone out there is listening right now and they're saying to themselves, well, yeah, I want to try TechVestor, but I also want to call a couple other funds. What are some red flags that people should be looking at, or maybe some good things, good questions to ask these funds as they're looking to potentially invest?
Yeah, I would look at track record and size. We've seen a couple 15-unit portfolios that have recently shuttered, and there's a fire sale of assets. I would ask about debt structure. Part of the reason that 15-unit portfolio ended up collapsing was they took a lot of short-term debt. I would talk about what's the debt. I'd be asking about the reserve level. It's something we really try to keep is, an extended amount of times of debt service held in reserves. Obviously, the more you hold in reserves, it's going to lower your returns. But for us, those are just key things. You never want to run out of money, have to do a capital call or sell an asset because of that. So, those are kind of big things I would look at is, what's the track record? How far along? What's the debt structure? Those are things that can really trip you up as you're building a portfolio that you would really want to make sure of. And ultimately finding out is operational control. Who controls the asset, who's operating. Unlike long-term rentals, if I'm the best leasing agent in the world and can get $2,200 a month for the place and market rents $2,000, I'm not going to go get $4,000. But in this asset class, there can be huge 30 or 50% swings of revenue from operator to operator. If we gave the keys to somebody else, revenues could drop 30% overnight. That wouldn't be that uncommon. We've inherited other people's Airbnbs and, driven more revenue. We bought a property in Scottsdale that was already doing $141,000 in revenue. We changed out the furnishings, still the same amenities, still had the pool, still had the fire pit, still had the game room, just swapped out the furniture that we knew would be better, put in our operational infrastructure. That property did 210 its first 12 months that we took over.
Nice.
So there's just huge swings of opportunity from an operational perspective. So you just want to find out who is ultimately operating the assets, not necessarily operating the fund, because those might be two different people.
Yeah, that's great. Well, Taylor, you've been a wealth of knowledge, brother. I've loved hearing your journey, and we appreciate your time on here. Kyle, do we have any last thoughts, any last questions?
No, this is great. I'm just encourage people to go check out TechVestor. Any online presence as well outside of that? Instagram. I know Lame follows you on LinkedIn. Anything you want people to know about for that?
I'm pretty big on LinkedIn and Twitter. I try to share, give back, tips, tricks, things we've learned. Really this asset class is still in infancy. I'm a washed up baseball guy. I kind of say this is like the third inning, realistically, when people are looking at short-term rentals as a whole. And for me, I kind of do believe it's a rising tide lifts all boats. I don't feel like, I'm giving away all the secrets or, somebody's going to be able to go compete. Like, it's not like it's hard to figure out what our homes look like, exactly what markets they're in or anything like that. For us, like, I want there to be as many good operators as possible, because if somebody has a good experience staying at your property, well, guess what? They're probably going to come back and book again. But if they have a bad experience, they're going to leave the platform and never come back. And then I don't have a chance to secure them as a guest. And so to me, I do really have that mindset. And, whether it's Twitter, LinkedIn, I'm trying to share, every day with something short-term rentals related.
Cool. How do they find you on Twitter? I'm assuming LinkedIn is just Taylor Jones.
Yep. At Mr. Jones STRs, Mr. Jones STRs.
There we go.
Yeah, there we go. Slide it in there.
There it is. There we go. Awesome. Thanks, brother. We appreciate you, and congrats on what you're building and continued success. Thank you for helping our audience conquer the world of short-term rental funds today. So, Lame, I got to know, man, you're building your fund through the creative acquisitions model, right? Yep. And that's something that has a ton of benefits, but being a devil's advocate here, Taylor did mention, like, one of the red flags was, what kind of debt are you getting? And if it's short-term debt, that can end up turning into a fire sale, or, if you got to sell or refinance at the wrong time, that could put you in a bad situation. So what do you think about that? What's your response to that when you heard that?
Yeah, I think so twofold, right? So first one is I don't think he's wrong, right? And I think you can get yourself into trouble if you're not being very intentional in what kind of debt you're getting. He spoke to short-term debt. He also spoke to how there's some debt he's signing on that's 8%, right? And it sounded like that they're essentially just using DSCR loans, which is whatever market is, which right now we're at about 7.5. And they're just using that to underwrite deals. Now, the crazy thing about this asset class is you can still cash flow with interest rates like that. Yeah. Like, if you're looking wide and far enough, like, there are deals out there that will breed cash flow given that.
100%.
My specific strategy, right, with the CASTR method, with creative acquisitions, more or less essentially guarantees a much lower floor of debt that allows for a much more profitable month-on-month return. which again adds to the lowered barrier of risk of like, hey, if I'm cash flowing for 5 years, that gives me a lot of opportunity to be able to stack cash, to be able to make all of the return of what I put into the property. So at that point, I'm just playing with house money, right? And so I think really it just comes down to, making sure you're making wise decisions on the deal. But where creative comes into play that he can't touch is the interest rate, which effectively is the cash flow, right? Because if I'm getting a 4% interest rate while he's getting an 8%, that right there is like $2,000 of cash flow that like I'm not having to account for.
And spread over 100 properties. That's a ton.
Exactly, right? And so, it's crazy because there are properties where, because of the creative structure, right? I have an incredible interest rate. I put less than 10% down. There are deals where I've literally made the 100% cash on cash within 18 months. Yeah. So then at that point, let's say we get to the end of the 5-year short note, right? What is my risk? I've been cash flowing and stacking cash for the last 5 years. If that property did not appreciate at all, at the very least, I'm going to be able to get my money back from the principal I put down. But like, that is a very unlikely scenario where this property doesn't appreciate in 5 years. Let's be real. Is that going to happen? Like, unless a recession happens, which could, it could hurt. But at that point, I've already made enough cash flow back to where it doesn't really matter, right? And so that is where I think these two worlds are a little bit different. But again, just understanding the landscape of, how you're utilizing debt, what your exit is going to be, is really what makes this work.
So just really quick question, and then we can wrap this up. I'm just curious. You asked the question, why did he start a fund? I want to ask you, why did you start a fund?
Yeah, honestly, it's really because of the amount of capital that's available at different levels. So I went and started a debt fund, and this is fairly recent. It's only been about 6 weeks now. Wow. And full transparency, I've raised that fund at anywhere between 8 to 12% on debt, meaning they're just getting that return on whatever money they put in, zero equity. And what's crazy is, like, I launched it at 5 million. We already have, about 7 figures of LOIs at those terms, meaning I'm just finding people that are willing to just put in money with no equity upside. They just want a safe return in an asset class that is backed by real estate, right? And which this is. And so for me, it was just an opportunity to be able to go capture bigger money, to be able to go deploy and do what I do well, right? And the crazy part about it is, because it's a debt fund, I'm going to keep all the real estate. Like, all the equity is mine. And so at this point, I just have to be operationally sound to get the returns, and then I keep everything else, right? And so that's the beauty of it. So to me, it was just to go bigger and to go wider with, more attractive debt. So
cool. I love it, man. Well, guys, as usual, right? If you're hearing all the things that we're talking about on how Lame is buying creative acquisitions and turning them into short-term rentals, and you're all for that, you should be all for that. I mean, I don't understand anyone that wouldn't be all for getting market rates at 3 to 4% right now, when the rest of the world is getting 7 or 8%. If you're all for that, just click on, there's 2 links down below, whether you're listening on the podcast or on the YouTube channel. You can book a call with Lame and his team right down below. Learn how you can get into this CASTR method, learn how you can start building up that portfolio, or you can use our free 5-day challenge that we did and have recorded and have as evergreen content for you, that you can go and start using that information to build your CASTR empire as well. Both those links are down below. Lame, any last words?
No, just take a bet on yourself. And hey, these deals are out there. They're out there for those that are willing to put in the work. So,
all right, guys. We'll see you next time on the Fearless Investors Podcast. We're helping you to conquer the world of short-term rentals. We'll see you.